welcome to Ainslie News. It's Wednesday, the 9th of September. Today we're talking the calm before the insolvency storm. Raoul Pal's The Unfolding Thesis continues to play out. As we've outlined, his thesis plays out in three phases. First is the liquidation phase we saw in February and March. Then the hope phase that has played out until the last three nights, share market bull trap rally, and next comes the insolvency phase. As he points out, no amount of monetary stimulus can prevent the insolvency phase, as it is about income and cash flow, not jawboning from the central bank. In Australia, that's been delayed, but purely through ASIC changing and relaxing the rules around what defines being bankrupt, and the government giving relief through JobKeeper, cash boost, debt repayment deferral, and others. In fact, the irony is that here, during the worst recession in a lifetime, personal and business insolvencies are rock bottom. This here, or chart, is from Macro Business, and showing plunging personal insolvencies. We've literally had the opposite of insolvency during 2020, which makes absolutely no sense. Whereas the number of companies entering administration also plunged to less than 50% of normal levels. This next chart here is showing companies entering external administration in Australia. So we've actually seen a bit of a decline there. From the Sydney Morning Herald, the shielding of businesses, including billions of dollars in government stimulus and wage subsidy spending, has resulted in a dramatic drop of insolvencies on Credit Watch data. While some employers have been protected, will recover. Credit Watch Chief Executive Patrick Coughlin warned there were about 2,500 businesses that were no longer viable being kept afloat by the rules. And that's before we're taking into account that we're in the worst recession in 90 years, Mr. Coughlin said. Under the insolvency law changes, creditors are unable to issue statutory demands or bankruptcy notices until the debt totals $20,000 or more, up from $2,000 and $5,000 respectively. Directors are also protected from personal liability under insolvent trading rules if debts are incurred, except where they break the law. This next chart here is showing insolvencies in Australia since March 2019. And again, showing a reduction, ironically. Ultimately, all these businesses need to go into administration, plus those that have been severely affected by the coronavirus, he said. Macro Business goes on. Clearly, Australians are living in an artificial bubble right now, and insolvencies are likely to surge once emergency income support is unwound from October, mortgage and rent payment holidays are unwound over a similar time frame, and Australians can no longer withdraw their superannuation early, or they've exhausted their funds, with the expiry date on early withdrawals set at 31st of December 2020. On the first point, the Grattan Institute estimates that income support will fall from $18 billion a month, or 10.7% of monthly GDP, to $3 billion a month, or 1.9% of GDP, for the 6 months beyond. This chart here showing the fiscal cliff, which we've talked about before as well. In turn, insolvencies will balloon once temporary safe harbour rules for companies expire. Last month, ABC chief economist Alan Coyle noted that insolvencies caused from the GFC peaked in 2012, 4 years later, and that's what always happens. The average time between a business going insolvent and admitting it is 18 months. This is going to be a long, catastrophic wave of insolvencies that will lead to higher unemployment and pressure on the banks. In other words, this is the calm before the insolvency storm. The Morrison government can delay, but not prevent, the oncoming economic pain. The insolvency phase appears locked and loaded. Only time will tell whether the rout again last night on Wall Street, the Nasdaq was down 4.1%, and the S&P 500 was down 2.8%, will be the end of this hope rally before the long leg down that we talked about on Monday. That article reported a well-proven algorithm that predicted that we are 100% due for that now. Any dispassionate look at the US share market must tell you we were just witnessing the usual blow-off stage of such a bubble. Companies like Tesla, priced at over 1,000 earnings, or 1,000 times earnings, institutional and insider money exiting while retail crowded in, and all valuation metrics at all-time highs, is screaming a warning those same mum and dads and Robin Hooders that always come in to take the bag at the end. While this phase will likely be deflationary when the crowd is worried about inflation, the setup is still very bullish for gold, where it is proven as a safe haven role and as a hard asset without counterparty risk, and further bolstered with an ultra-low interest rate environment will come to the fore. There will be a lot of money looking for safety all of a sudden. That is usually gold and bonds, but there are a growing number worried about entering bonds when rates are already near zero. And a vaccine does not miraculously change what is already largely baked in, and not what was already weak before the virus even pricked the bubble. If one becomes available, it might fix your health, but it will take a very, very long time to fix the economy. Well, that's news for today. Remember, you can always go to ainslieBullion.com.au to buy and sell and research any of our gold and silver products. Go and check out Ainslie Wealth for any of our cryptocurrency products. And also goldsilverstandard.com for our gold and silver backed cryptocurrency, giving you ease of purchase and portability. We'll catch you tomorrow for more news.